Good evening to everyone. So my name is Suresh. So as ASK, we've been doing a lot of webinars on the giving more knowledge about our products. We've been actually a few months back, we came with the lighthouse from the one of the from equity side, we have a satellite portfolio. Second, we had underlining of real estate. We also launched a high yield the debt fund to I think that also we have been went to a lot of partners and everything. So now we are the third segment also, which is into a absolute and fund long short strategy. So this is what actually today is the I think we would like to have a more discussion with our Mr. CEO of Air Solutions, Mr. Vaibhav is available. So today we would like to take the product. We would like before the product, you would like to give a knowledge about that also where it suits. So Mansi will in terms of the give about brief what exactly we are going to do today. Over to Mansi.
Thank you, Suresh, and good evening, everyone, and thank you so much for your time and joining us today. I have with me Vaibhav Sanghavi, who is the CEO of the ASK Hedge Solutions, which is another vertical of ASK IM. I'm sure you've heard about different products from the ASK IM or the ASK fund house earlier. This is a different product and a differentiated product which we will be talking about today. Vaibhav here has been a veteran in the hedge fund industry with more than 18 years of experience. So the core team has been managing this strategy or the fundamental long short for the last 17 years. So this is the longest track record you will ever find of the team doing long short strategy in India. We've also been managing this on the public platform for the last 10 years. So this is this is the longest track record you will ever find of a team doing fundamental long short in India. Now, to discuss in terms of why this product at this point in time, how does it benefit the investors, what role does it play in, your client portfolios is something that we are here to discuss today. So for that, I would like to hand over to Vaibhav to take you through the details, and then, we will open it up for question answers, and we'll be happy to address any of the queries that you have. Vaibhav, over to you.
Thank you very much, Mansi, and thank you, Suresh, for the kind introduction. First of all, let me tell you that I am extremely pleased and honored to be amongst an audience of advisors who have actually played a very important role in terms of the financial literacy of this country. Now, while you have offered your advice and products to your esteemed clients, within the given spectrum of strategies, we thought that it will give us an opportunity to present to you something which we can bring to you and for your clients' portfolio, something which is, extra modern, something from an innovation perspective, it is quite prevalent into the global markets, but we thought that is something which we can bring into India and give it to you and your clients as well. So in this, short brief in terms of how I will take this session going forward, what I will do is basically first try to introduce to you why long short as a philosophy. Within that long short, what is it that we as a business are planning to do? And then trying to probably cover our flagship strategy, which we have done for last 10 years, and how does it add value to our clients' portfolio as well. Once that is kind of done, I will briefly take in terms of the investment process and probably the risk measures around it. And lastly, then we will do is basically to try and take questions from you all, because that long short is kind of relatively new to the larger audience. We would love to have any kind of basic questions also, and I would love to have, I would love to answer each and every one of them as well. So let me start with, by just kind of mentioning, why long short, first of all, and what is long short all about. Now, when we talk, long short strategies, right? Long short actually is very loosely used terminology in a common investment parlance. Basically, long short only gives you an ability to take a bullish position and a bearish position into a portfolio. Now, while that is an ability which is there, for an investment manager to do it, what we can essentially do with that flexibility in hand is try and construct strategies which are across the risk spectrum. Meaning that if I am using long short as a methodology, I can manufacture strategies which are extremely conservative in nature, and actually are like debt in terms of the risk and return profile, to extremely aggressive in nature, for which the risk and the return parameters are like equity as an asset class as well. So point being that long short is just a methodology, and with that methodology you have an ability to actually generate that risk adjusted return and deviate from your normal risk return curve. Now, yeah, these are all probably, some of these are technical terms, and what do I mean by risk adjusted returns? Why is it that it adds value to portfolio? I'll take each of those kind of terminology as we proceed on in terms of this session as well. Now, in the current scheme of things, right, when markets are at 24,500 levels, and it has been a fantastic story for equities as an asset class. It is very boring to talk about debt as an asset class. And when this strategy, when I'm going to talk about, is actually suitable for investors, which has investments into their debt buckets, because it adds a huge amount of value there. So while we talk that, it is very boring in nature, why we are talking about debt, let me give you one simple anecdote or probably an example. When we look at, our cricket team, right? And in cricket team, there are, say, 11 players. Would you foresee a cricket team which has all 11 members of, the team as Virendra Sehwag? Of course not, because Virendra Sehwag is extremely important, and, they will give that fours and the sixes and everything. But a team is actually made up of very aggressive players, very conservative players as well, like a Rahul Dravid, who can be the backbone of the team, as well as bowlers and wicket keepers. So our team, when we talk about, consists of all different type of categories of players. Meaning, when we talk about our portfolio as well, it is extremely important to have our money into various asset classes, including equities, which is right. But at the same time, to give the stability to the portfolio in terms of the debt or various other asset classes, which can give you those kind of diversification. Now, having said that, and given that it is extremely important to have your some amount of allocation, continued allocation into your debt, then the natural question would be, then how does kind of long short strategy kind of give or add value to those kind of debt bucket? Now, for that, what I would like to say is basically in terms of the objective of this strategy. The objective of the strategy which we are kind of presenting, which is ASK Absolute Return Fund, is to generate net positive return irrespective of market conditions, with a return which is at an alpha, or probably gives you an additional 100 to or aims to give you an additional 100 to 150 basis points net of tax and net of fees. So when we talk about a 12 to 15 month of instrument, you can list down, say, money market instruments, liquid funds, fixed deposits, and off late, you can also say, one of the fantastic returns has been given by arbitrage funds as well. Now, everybody knows that arbitrage, though in the last year has performed very well and given you to that yields of about 6.5% to 7% post-tax, post-fees, what ASK Absolute Return Fund aims to do is to generate an alpha of 100 to 150 basis points over and above the best performing instrument within that class. So in this case, arbitrage being the best, we want to generate that 100 and 150 basis points over and above that, right? So in terms of the positioning, when we talk about a strategy, we essentially look at two critical variables to understand the risk and return profile, and why also will tell you that why do we compare this strategies risk return profile equivalent to debt as well. Now, when we talk about two critical parameters, the first one being that you look at risk parameters of this strategy. Now, when we talk about risk and when we talk about that this strategy is commensurate or comparable to the debt class, what this strategy has the characteristics essentially is to generate those returns with a standard deviation or a volatility of about 3 to 4%. Now, what does this standard deviation or volatility would mean in terms of the 3 to 4% is basically that, equities as an asset class comes with a volatility, long-term average volatility of about 15 to 16%. Whereas any debt instrument like a duration product would generally have a volatility of around 3 to 4%. So it is extremely important to understand that the volatility of ASK absolute return fund is aimed to have around 3 to 4%, which is comparable to any other debt instrument which is available in the market as well. So that's on the risk side from a standard deviation or volatility. Now let's also understand in very simple and a common language that what is the risk of a drawdown. Now drawdown meaning that what is the risk of negative return in one particular month, and why are these essential elements to look at when we are pitching ourselves against a very fixed income product, is that you cannot have a strategy which kind of gives you say 5%, 7%, 10% down month when you want to place your fixed income money into this. So if you look at the characteristics of the strategy again, typically these strategies will come with a drawdown profile which would be less than 1% in any kind of market condition. So in my experience of last 10 years, the highest drawdown has been less than 1%, and that also in month of COVID, where where the markets were down by about 25 to 26%. So what would I mean from both these two risk parameters is basically that the risks to a great extent is comparable to any other debt instrument which is available, and that is why we pitch that kind of product against the debt allocation. Now, while we talked about the risk of this strategy, let's also talk about the returns of the strategy. And when we talk about returns on this strategy, again, coming back to the same point, is we aim to generate that 100 to 150 basis points higher, which means, again, a perfect example of risk adjusted return, that while you are taking in risk which is similar to a debt, but generating that return which is higher than debt. Okay, and that is how we aim to generate that value add onto the portfolio. So that's all about in terms of the positioning of this strategy. Now let's come to the important aspect that, how do we generally go and achieve this kind of returns? Also, before I kind of highlight and go to this process of investing, I would also like to kind of give you one more example that while you are investing in debt, anything better in terms of a return is always welcome. And I'll give you a simple example that, when you are flying, say, from Mumbai to London in a business class. Now, if you are traveling through a great airline, and if the airline gives you a complimentary upgrade to first class, everybody would be thrilled to have that kind of additional service or an additional kind of kicker in terms of that experience of that journey. It's the same thing where what we say is basically you have that consistent return in a debt bucket, but this is a product which gives you that additional experience, a pleasant experience over and above your normal debt returns as well. So those are the few analogies which I thought I'll probably kind of place it up to you. And let me kind of then move on to making you understand how do we approach it as a strategy, and why is it that we have been so consistent, month on month, year on year, to generate that kind of returns along with those kind of risk parameters as well. So when we look at the markets and when we look at fundamental long short of investing, typically what we do is basically that we generally categorize, risks of investing into two different segments. One is basically your market risk, and another is your stock risk. Meaning, there's always a question which we face, when we go to the clients that, hey guys, you are investing into a fundamental long short equity strategy, but your returns are very, very, very smooth. How is it that which is possible? What we do is basically at the core, when I say at the core of capital protection, is that our objective is the foremost objective is to see to that your capital is protected at every given point in time. Okay, that is virtually our obsession, in terms of that we cannot see, or we are extremely averse to seeing those kind of drawdowns, which exactly reiterates that we are kind of pitching against the debt or fixed income kind of strategies. Now, when we look at the risk parameters and we look at the market risk, just to give you very basic understanding of market risk, is basically that any change in the returns of your portfolio to the change because of a change in the underlying market conditions is called the market risk aspect of investing. Meaning that if market generally in an equity market, if you are investing, if the market goes up by 10%, your portfolio will do fantastic and you will get some good returns. But if market goes down by 10%, those long only strategies you will find losing huge amount of money as well. So what we do is basically, when we say that we want to generate returns irrespective of market conditions, we mitigate that market risk component by incorporating two very essential elements into that risk management. And there, what we do is basically, we would always have hedges onto the portfolios, and two, we will always also try to see that we are not faced with any binary risk event in terms of the portfolio positioning as well. So any event which has the potential to take the markets up or down by a huge margin, we will go highly hedged during those events, by which we are able to mitigate a good amount of market risk, on an overall portfolio returns perspective, over a consistent period of time. Now, while we would have kind of controlled the market risk, the other natural question we are always asked as well is, what about the stock risk aspect of investing? Meaning that whatever stocks you take into the portfolio that might go wrong, how do I protect that as well? And for that, what we do is basically we have a very thorough institutional process of investing. At the same time, over and above that process of investing, we have an extremely tight risk framework coming over and above the process of investing. By having all these four parameters into the kind of portfolio management, what we have been able to do is basically generate a portfolio return, which is extremely low in volatility, extremely low in terms of drawdowns, which is the negative returns, a very, very consistent return profile, and lastly, a sustainable performance over a longer period of time as well. Right. So in conclusion, what I would say is basically that this is a strategy which is exactly suited to generate that additional return or your fixed income bucket of your portfolio. Of course, I keep on repeating again, it's a very boring kind of strategy nowadays. But from a long-term perspective, on an asset allocation perspective, for the stability of the portfolio, when you allocate to the fixed income component in any of those instruments, this is an instrument which will give you that additional advantage of about 100 to 150 basis points over rest of the competitive 12 to 15 month kind of instruments. Lastly, what I would like to say or request Mansi is to take you through the specs of the product, the fee structures, and probably how it is kind of structured as well. And then we will take some questions at the end. And if you want, I'll probably also highlight the market view ahead of the budget as well in the end as well.
Sure. Thank you, Vaibhav. Maybe I'll just quickly take some of the key features of this fund. So like a debt fund, obviously, even though you're looking from a 12-month perspective, this fund does not have any exit load or any lock-in. But however, there's a monthly liquidity available. Given the nature of the investments, you have a monthly valuation. That's why it's a monthly redemption window which is available, but there's no lock-in or no exit load. So even though you come from a 12-month perspective, in case there's any liquidity requirement at the end of 9th or 10th month, you're free to exit with a 5-day notice period from the month end. Also, in terms of subscription redemption, the minimum subscription amount is a 1 crore, which is the SEBI-regulated amount. You can enter this fund twice a month. One is mid-month and the end of the month. However, having said that, the entry is anytime during the month. So say suppose my window for subscription is say 15th of the month, and you get in around say the 10th or the 12th, what we do is we park that amount in a liquid fund, and on the allotment of 15th, we kind of switch the money from the liquid along with the increment to that. So you can enter at any given point in time. However, the allotment happens mid-month and month-end, and the redemption is monthly. In terms of the fee structure, we have 3 share classes over here. One is your fixed fee, so say up to 25 crores. That's the share class A3, where the management fee is 1.75%. The other share class is A2, where we have a combination of fixed fee and a performance fee over a hurdle. Now here you have a fixed fee of 1% and a performance of 20% over a hurdle. The hurdle is defined as your HDFC Bank fixed deposit rate, which is 1 year, 1 day, plus 25 basis points. Now, the question will be, why HDFC Bank fixed deposit as the hurdle? Typically, when you're looking at fixed income instruments, the client will say that, from a 12-month perspective, if I park my money in a fixed deposit, anyways, I'm going to get X amount of return. So why should I pay you for the return which I will get in a fixed deposit? That's why we've kept that as a hurdle, plus 25 bips for the incremental risk that we are taking. And the performance fee is charged only on the incremental return. There's also another share class which we've added, which is A1, which is only performance fee. Sometimes there are clients who say that, I am okay once you cross the hurdle, I'm okay to pay higher performance fee, but I don't want any fixed fee charge. For them, we have the share class, which is A1, where there is 0 management fee, but a performance fee of 37.5% over the hurdle. Again, in terms of taxation, okay, which is very important, given that this is a Cat 3 AIF, the tax is at the fund level. So it's paid at the, the PAN of the fund. And whatever the client gets is tax paid income in his hand. So once you receive the redemption proceeds, it's already tax paid and you do not have to pay any tax on that. However, it won't reflect on your 26 AS or the investor's 26 AS because it is a fund level. Again, the taxation is at MMR because it's business income for the fund. So it is taxed at 39%. So these are some basic specs of the fund. Maybe, I can ask Vaibhav to briefly touch upon his market outlook and what his outlook is on the budget and what he's thinking. And we can open up for question and answers. In the meantime, please feel free to, even post your questions in the chat box and we will be happy to take them as and when you post it.
Yeah. Mansi, before going to the outlook by the Vaibhav, okay, I think can you just brief about the Hedge, the return strategies, what we have like a debt place, equity place, so that I think it will help the people to understand and what type of we are actually having this fund, the categories, and we are coming with the new funds also, which will help the people. Then I think Vaibhav can give the outlook, and you can also touch upon that. How did we perform so far Okay,
Sure.
that actually will help the people to market to their clients also.
Sure. So maybe first I'll touch upon the performance of the fund. So this fund was launched on 31st of Jan. So it's been 5 months of fund performance that we have done. If you look at the 5 months performance on a gross basis, the return has been 7.22%, which post fees, post tax works out to about 3.7%. Now, this is for 5 months in absolute terms. When I annualize this is about 9% on an annualized basis. So when I compare this to any of your debt alternatives, so for example, as Vaibhav mentioned, arbitrage has been the best or the flavor of the season for the 12 months. If I look at arbitrage and compare it, arbitrage on an annualized basis has been about 7 to 7.5%. Versus 9% of this fund. So in this short span, I've already seen that 1 to 1.5% outperformance over that. And that's why we say that from a 12-month perspective, we are very confident of generating that alpha. So what this does is, one, it adds to your portfolio diversification. And second, it also enhances the yield on your fixed income portfolio as mentioned by Vaibhav. So again, from the return perspective, from a 12-month, kind of an investment horizon, we are, targeting that 100 to 150 basis points, which so far we've been able to do. That's on the performance and on the fund. Now, as Vaibhav mentioned, long short strategy is just a tool to kind of manufacture strategies which can be very conservative to very aggressive. Now, this one which we talked about was a very conservative strategy where the objective is first to preserve that capital or protect that capital and generate these returns, and hence an alternative to your fixed income portfolio. The other product that which we will be coming up shortly is your aggressive alternative or an equity alternative. So there, the idea is going to be to outperform your Nifty, post fees, post tax by at least 2.5%, 3%. In the last few years, we've seen, many mutual funds or other large cap funds have been unable to beat Nifty or unable to perform Nifty. And that's why we've seen a lot of movement towards your index funds or ETFs or passive funds. Having said that, again, you do have some tracking error on that perspective, and that's why that outperformance over Nifty has been very difficult. So the idea here is to formulate a strategy, which will be a long biased, long short strategy, which will create that alpha. So you will have a passive portfolio reflecting, some underlying indexes. So you will have a portion of about 80 to 100% in a long only portfolio, which will be complemented by a long short. That can take your exposure by up to 100% or, on either sides to kind of enhance that alpha in a uptrending market and try to limit your downside in a downside market. So this is something that we will be coming up in maybe 2-3 months time. We've just filed for that fund as well. But that again, it will be an equity alternative and an alternative to your large cap portfolio. Vaibhav, in case you want to add something on the strategy,
No, I think you've covered well in terms of the equity strategy. While that is something which will come to all of you as a partner, in the next few months as we are ready to kind of launch. But I'm sure it's going to be an extremely exciting, strategy, which gives you that edge, again, of that risk return, risk adjusted return, trying to generate equity plus return with equity minus risk. So that's something which will definitely come about. But at this point in time, we will probably focus on our ASK absolute return fund, which is a debt alternative and a fixed income alternative in that case. So that's what I would probably mention.
Excellent. Now, I think Vaibhav, you can give your outlook. Then I think I will take any Q&As from the people. So then over to you. Thank you.
Sure. So, the way we are currently looking at the markets, and I will try and segregate the view both between global markets and local markets. Now, from a global standpoint, what we are seeing is basically it's a very complex situation where if you see the kind of interest rate environment, it's completely opposite in different countries. So, for example, if you see Eurozone kind of as a geography, They are here, they've cut the rates. Bank of Canada has cut the rates. On other side, China is also easing in terms of their monetary policy. But we have the largest economy, which is US, which is continuing to hold on to that rates. And lastly, the Japan is something which is kind of, in a mode to kind of hike those rates as well. So it's kind of a scenario where there are kind of huge amount of opposite forces in terms of the interest rates, and why we generally do think that interest rates are kind of important from a global scheme of things is to try and ascertain the mood of the global foreign institutional investors towards emerging markets. And when we talk about emerging markets, then subsequently to India as well. Now, just to give you a background, in the last 4 years, the foreign investors in India, if you see the net flow coming from there has been virtually, flat, right? And in that scenario, the markets have kind of gone up, good size amount as well. Which what has led to that is basically that the earlier ownership of FPIs in India, which was close to about 21-22%, has now kind of decreased to close to about 16.5, 17%, which is virtually at a 12-year low. Now, here is a situation where our markets have actually gone up in terms of the weightages in the emerging market from 8% to 18%. And at the same time, their ownership at an all-time low. And in a scenario when the rates are starting to go down, whenever state rates go down from a global market standpoint, you will always see money coming to emerging markets and subsequently to India as well. So you may see huge amount of inflow coming from the foreign investors into Indian markets. Now, while that happens, typically we will see that when they invest, they will largely invest first into the large cap bucket. So as against the performance of mid cap and small cap, which has been fantastic over the last few years, here is a situation where we do think that both on the valuations as well as the flow which is likely to come into the large cap, for the coming year and a half to 2 years, we do think that a large cap as a bucket will perform much better than the mid and the small cap bucket, where the valuations are already high or stretched in some sense, right? I'm not saying that they will not perform over a very long period of time, like a 5-year or a 10-year, but it's just that in the next 1 to 2 years, large cap is a bucket where you can see some good amount of interest. Lastly, from a budget perspective, let's see how the budget comes about, purely because, in the last 10 years, one of the consistent things with the current government has done is always have their focus on the supply side, meaning that they've always focused on the capex driven economy boost and not actually focused on the consumption side till now. What do we think from here onwards is here is a chance for the current government where the overall fiscal math is kind of very favorable to them purely because of the RBI dividend which has come to them, is a chance for them to boost some amount of consumption as well. So if they do boost consumption along with the capex which they are doing, then it can be a double engine budget which may come about going forward. I'm not preempting it, but if just giving you that scenario that if they do that, then our growth can accelerate further from your GDP forecast perspective as well, leading to that earnings forecast kind of, be available, or probably we can achieve those numbers, which everybody is expecting. Now, if that doesn't happen, then we may see some amount of marginal downgrades in terms of the earnings. And lastly, that the markets will go and follow the earnings. Lot of the re-rating story is already over. So whoever delivers those kind of earnings is what we do think that the performance will come in terms of their stock prices as well. So focus on earnings, on robust earnings growth, and that is where you will make money, and focus on large caps, at least in the next 1 to 2 years, where the relative outperformance and the cushion in terms of the risk would also be there, right? So, but that doesn't give away in terms of the fantastic next decade to 2 decade opportunities which we have in India. So that is what we think from a market view perspective.
Thanks, Vaibhav. I think it's helped a lot on the fund size as well as the outlook also. Uh, Friends, we request you any questions you have, any in terms of is this category itself is a new category. So you might be taking to your client space. So you have any basic questions, you can keep on chatting on the box. Behalf of you, I would like to take it to the Vaibhav and get that to our client space. Yeah, Mansi, before the questions will come, can you just explain in terms of the how the investments will happen, when they can redeem, how it works? So that will help the people. So in generally equity, like whenever I want, I can invest. Same like in a mutual funds, I can invest whenever I want. And a click of button, the money will come. So can you just explain on that how the client can, when the client can invest, when the client redeem, how it will, any charges or anything that will help us?
Sure, not a problem. So just in terms of, subscription redemption, now subscription can be done twice a month. So that is mid-month and end of the month. You can do the investment once the onboarding is done, the AML is okay to funding is got, you can still give the money much before the subscription date. So say, for example, my subscription date is on the 15th. I can still take the money if everything is clear by the 12th, 13th. I will park it in liquid funds. And then on the 15th, I will transfer that entire amount along with the appreciation in liquid funds for the allotment. So subscription is twice a month, which is mid-month and month-end. Redemption is only at the end of the month, unlike mutual funds, which is a daily redemption thing. The valuation here is monthly. That's why your redemption is only end of the month with a 5-day notice period. So I need the redemption request at least by the 24th or 25th of the month. Once I get that, the redemption will happen on the month-end NAV, which is say 30th or 31st. And the amount is then credited to the client's account on a T+4 working days. So that is the span of amount from the redemption to your or to getting the money in the client's hand. So that is how it is little different from the mutual fund, and you need slight planning in terms of the liquidity which is required.
Excellent, Mansi. That actually helped. The questions have started coming on the chat box, so I'll just try to take one by one. Mansi,
Yeah.
I think can you just tell us that how many months somebody has to plan in terms of is it for 12 months, is it for 6 months or 9 months? Somebody is investing into this type of category, because generally somebody investing into a liquid funds, so people will plan for 2 months or 3 months. So such a way, if somebody is investing, what is the minimum months somebody has to keep in the mind? That's
Sure.
the first thing the question has come.
Sure. So one is at least keep a 12-month horizon in view. Okay, so when you're come from a 12-month perspective at least. If you ask me that, okay, I have only money for 3 to 6 months, can I come into the fund? I will say no. The reason being, when you look at this fund, it's not a linear movement of returns. Okay. So say, for example, if I'm targeting a gross return of say 15%, okay, which is 1.25% every month, it's not going to be a linear movement. You will see some months which are higher than the average returns, some months where it could be muted. There is a possibility of one or negative month in the 12-month window. But from a 12-month perspective, when you see that, it evens out and you're able to achieve that target. That's why we say come from a 12-month horizon. Having said that, if you need liquidity, you have monthly liquidity. But what happens is, if you come from say a 3 or a 6-month view, that time, depending on the market environment, the situation in the market, we might be, generating slightly lower than the average returns. And that leaves a very different experience and a bad experience for both the investor as well as the distributor. So that's why we say at least look at a 12-month perspective when you're investing in this fund.
Excellent. So the following, it is like this, as the investments is mentioned about a CAGR works about a 9%. Is it a net, I think a net tax and free, or how is that? Is
Yes,
it a gross?
it is post-fee, post-tax. So if you look at my absolute returns on a gross basis, is 7.22% for 5 months. Okay, post fees, post tax, that is about 3.7%. So when I annualize that for a 12-month period, that comes to about 9% as of now.
Excellent.
I want to add here, Suresh, is basically that, while the return performance have been kind of very good and to a great extent in line with our expectations as well. But when we guide in terms of those returns, generally we say, or we continue to aim at 100 to 150 basis points net of fees or taxes, irrespective of what the competitive debt product is. Now, 9% here is an absolute kind of number. But if somebody gives you, say, 9% itself, right? Our aim would be then generate 200 to 150 basis points over and above that as well, right? From a debt instrument perspective or a debt bucket perspective. So a lot of it is also going to depend upon how the interest rate environment is also going to be there, prevalent.
Excellent. That's helping. Like like when keep the advisors were selling about an equity PMS, the underlying is equity. Okay, so we were telling about high yield credit fund. We came to know that the underlying is about real estate. So a lot of people are asking what is underlying here. So they wanted to be curiosity how it is going to generate. So basically that where the money is getting invested. So that if you given a
Sure.
simple way to the explanation how the money is going to create, that help.
Sure. So when we talk about a long short fund in this case, and when we talk about, say, fundamental long short, it is basically trying to have a view on the markets, sectors, and stocks. Where will we go long on sectors and the stocks which we like on a fundamental basis, and go short on the sectors and stocks which we don't like on a fundamental basis, right? So when the essential point being, when you are long and short simultaneously on the stocks, to a great extent, you kind of mitigate the market risk, underlying market risk. Let me give you one simple example as well. Say, for example, if I have bought, say Larsen and Toubro, right, into the fund and sold HDFC Bank. Okay. Now, typically, if my stock selection is right, in a rising market, I will make some good amount of money in Larsen and Toubro, but I will also lose some amount of money in HDFC Bank purely because market is rising, then everything will rise. In that scenario, if my stock selection is right, I'll keep on generating that alpha while the market is going up. And similarly, when the market goes down, my HDFC Bank will make money for me because I am short on that. And I will lose some amount of money on Larsen and Toubro because that is also fall. So irrespective whether the market goes up or goes down, with my view on a fundamental long and short, I expect that to generate consistent alpha, whether the market is going up or whether the market is going down, right?
Excellent. So, thanks. So when we are doing it about hedging and all things, the question which is coming is what percentage of the assets will be doing a hedging about the portfolio?
Correct.
10, 20 or 30, so that will help the people to understand more.
Sure. An excellent question actually, because, if I see the characteristics of this strategy, typically my net exposure in the market will be close to about, say, 15 to 20%. At the same time, while that is 15 to 20%, and because there is some nuances in terms of how SEBI calculates the exposures as well, my beta of the portfolio is further down, close to about 0.07 or something near to that as well, which means effectively, I'm hedged to a majority kind of extent, right? Or to a large extent, virtually taking out the whole, market risk aspect of investing into the markets in any case. Yeah.
Excellent. Two parts here. Mansi, I think the taxation policy and the how it is working out. So on the gross return, how the taxation, because since it is involved the derivative component, how the taxation works here. So that will help the client.
Sure. The taxation here is at the fund level. So irrespective of the underlying investor, whether it is an individual, it is a corporate, the taxation is at the fund level. Because the underlying assets are into derivatives, I think that is the next one question also. So yes, the underlying investments are into derivatives. It's treated as business income. And because the fund is formed as a trust and the taxation is at trust level, the tax is at MMR, which is 39% over here.
Just to extend to that, Suresh, is while the tax rate is at 39%, when we talk about, and I will, at the cost of repetition as well, I wanted to say that our target of generating that alpha is post tax, post fees. So after charging for all the costs, including tax and fees, we want to have that alpha as compared to any of the other debt instruments.
Excellent. So, Mansi, in the category of the clients, so there would be a resident individual, NRIs and corporates, and as well as the US and US and Canada, particularly under the NRI category or the RI category. So, can you just brief about that? Who are unable, who cannot be investable, how who can invest? So that will help them to take it to their clients.
Sure. So resident individuals, any category of investors can invest. There is no problem on that. On the NRI side, at this point in time, we are accepting NRI money, but only through the NRO account. We cannot take money from NRE. And from an NRO at this point in time, we can accept money from UAE, Singapore, and Hong Kong, and even Australia. So these are the four countries. US and Canada is something that we will look at it, but maybe in, maybe few months down the line.
Excellent. So participants, so as we keep on getting questions, we have a few more minutes for the webinar so that we can utilize this to have answers from Vaibhav. I request all the people keep on chatting on the box. So as you rightly mentioned, once you the US and Canada, you need to come back on that matter. No problem. Yeah. So that will help into the things matter.
So there's just one more thing. I think there is little, if Vaibhav, you can throw light, because there are questions in terms of what are the underlying investments, and if we take F&O position. So if you can just touch upon that also, it'll be helpful.
Sure. So when we talk about investments into this fund, the way we will segregate our investments, typically we've seen that 85 to 90% of the investments are into derivatives and largely into futures, both on the long and the short side. And there's a possibility of about 10 to 15% into cash equities as well. So all in all, this is the configuration of how we will construct the portfolio. At the same time, when we are taking positions into derivatives, you don't generally need all the money to actually take those kind of positions into derivatives. So what we do is basically have some amount of money parked into liquid funds and use that as a margin to take positions on the derivatives, thereby optimizing the cash in terms of the returns as well. So those are the instruments which we will carry in terms of the portfolio.
That's great, I think. Yeah, Mansi. So I think.
Yeah, I think that's one more question, Suresh. So, Vaibhav, can you throw light on the various types of risks which are involved in this fund?
Correct. So when we talk about risks, right? I mean, in my history of 17 years, except for one single quarter, which was a COVID quarter, we've never seen kind of negative returns in that sense. But while doing that on a theoretical basis, let's kind of also consider that, when you are exposed to market risk, which I did mention that there are two types of risk, which is a market risk and the stock risk aspect of investing. Both of these, we have specific measures to cover both of them. And that's why you see those kind of consistency in terms of the returns and the very lowest drawdown and less volatility as well. In terms of the characteristics of the returns, there are two important points which I'll also make. One, that while we are doing long short on a simultaneous basis, what you may also expect is, say for example, in one single month, if the market goes up by say 10%, 15%, please do not expect this strategy to kind of go and match those kind of returns within those months, right? So that's in a way a risk factors for everybody to understand that we are not compared or we are not benchmarked to the equity returns. So during those times, you will find that we would be, lesser in terms of the amount of the returns which you make. At the same time, when the market goes down by, say, for example, 20%, at the same time, you will not find us losing that kind of money as well into our fund. Just trying to highlight that the characteristics of the returns are something like that in terms of you will not see any major movement in terms of the returns, on a month-on-month basis, as compared to the volatility. Lastly, I think Mansi did allude to this point, but I would reiterate again that is when we say, for example, target a gross return of say 14 to 15%, meaning that we will be generating, aim is to generate 1.25 per month. It doesn't mean that on a linear basis, we are generating 1.25 every month. There would be few months where we will be outperform that number. There will be few months we will be underperforming that number, and a one odd month probably negative as well. So overall, while you achieve that kind of targeted return, the journey is not as linear. And if you may consider these as risk factors, then I thought I'll just also make that kind of mention as well.
Yeah. Vaibhav, one more question. I think it's been answered in the presentation. How did the fund perform during the GFC, the global finance year in the 2008, that entire the year? How was the returns? If any of the funds had shown the experience of that, you can throw a light, because people, when they go to the client's place, the clients will ask about forget about the good years. Let me know the bad years. How did you perform?
Perfect. A great one, actually, a great question by, by the audiences. Now, in 2008, as I recall, right, and when we came into global financial crisis, because we were long, short simultaneously, we actually made good size money in 2008. Okay. Again, one of those characteristics of this strategy is typically, okay, whenever the markets go down, you will always find largely that this strategy will make money during the down market scenarios, purely because of our ability to do long short. So whenever market goes down, the ability of doing short and making money is pretty much there, which your normal traditional long only schemes, right from balance advantage to equity schemes, will not give you that kind of ability to do that.
Excellent, Vaibhav. I think that's actually the great session. What we covered about in a basic about why the absolute return fund and how we are maintaining, and to whom actually we can address. You can take this product to their clients, and that's actually excellent. So, partners, the one more request is that in the future, if you have a very great client, suppose example, you are an ultra HNI or some of the corporate clients in your city where we would like to come and visit, and to the clients, we are happy to come, so that you can get heads up about 10 to 15 days or 10 days before, so that we can plan accordingly. And we've been traveling across the places also we visited, so that will help in terms of to meet your clients also, provided with your permission, all those things. So with this, thanks you, Mansi and Vaibhav. We entire the subject as covered in a very simple way. Generally, a lot of people think about is when they use long strategy, the more technical and everything will come. I think today you explained very simple way how they can go and explain to their clients. There is a fund called long term, the absolute return fund, which will be placed between the debt plus category. They can make money. As will also come very soon with you people when the other category comes, which is a equity plus category, so that once approvals will come, we do one more call with all you people. With this, I would like to close the webinar today, and thanks for coming on this call.
Thank you very much.
Thank you so much.